So let's start up with a quick introduction. Janet will be talking about sustainable investing is for every investor who wants to manage risk. There's a lot of aspects to sustainable investing that she'll be covering. I know it's been a passion of hers because she's been doing this for a long time. It also fits into the alternatives that one has in investing, that some kind can basically follow what your passions are, or your beliefs, or the causes you have in the world, and so that becomes part of it. But it's become a really important area and is having an impact. And I would point out to everybody, when you hear CEOs of major companies coming out and talking about social issues, it's a manifestation of this same area of work. So Janet, why don't you start with your presentation? I'm looking forward to it, and I'm sure our members are. Thank you.
Thank you, Lynn. I'm delighted to be here today. And as you said, this is my passion. So I'm thrilled to be able to talk about impact investing. There's a lot to talk about. It's become more and more important in the crisis. So I'll just jump in, and I'll start by explaining a little bit about our firm, how it started and developed over the years. Then we'll look at the current environment quickly. But I really want to jump into the why, the how, and how it can really benefit investors as well as the world. So I'm starting here with an old picture of Bert Berry, the founder of the firm, and me. Because it's kind of a fun story of how I came to manage hundreds of millions of dollars. I was living in Europe and needed a job with an American financial services company that was selling insurance and mutual fund overseas. So I had to get up to speed, but I quickly saw how disadvantaged and unempowered these investors were. Who was making all the money was the salesman. I thought there had to be a better way. When I moved back to San Francisco, where I'm from, I had the good fortune to meet Burton Berry. And he was a real pioneer in recognizing that baskets of stocks, in those days mostly stocks, but also bonds, securities, managed by the best money managers in the world, were a very efficient way to follow market leadership. Essentially, he could hire and fire the best managers. So I've spent my whole career researching and quantifying the best ways to select funds. Of course, the industry has changed tremendously with ETFs. In some ways, the industry has come around our way of thinking, that you want efficient baskets that you can be flexible and adaptive with to take advantage of market trends. So I have been doing sustainable, responsible investing, is what we used to call it, for over 25 years. And that industry has changed a lot. So I want to jump into that. We still publish monthly guidance to help investors invest wisely. It's essentially knowing which funds to buy and sell. No magic, just the facts. Strategies designed to keep our subscribers in the best areas of the market, and importantly, out of the worst. But today's talk is the way you invest matters. I think we're all becoming aware of that. All investments have impact. At FundX, we help clients think not only about their goals. I'm sorry, I'm trying to there we go. My screen adjusted so it doesn't cover the slide when I see it. And I think I just got it. Good. Okay. So at FundX, we're increasingly trying to help clients think not only about their goals, but a little more about their values and what companies they want to support. Have you ever felt like you had to choose between your investments and your values, that you had to make money or make a better world? I've struggled with this for years. So I was running a San Francisco investment management firm, and on the weekends I was often, here's a picture of me building a clinic in Honduras, and I was on several nonprofit boards and worked in my local community in lots of places, and spent my work days helping clients build wealth. I would participate in these boards and often see a disconnect. The board would be doing tremendous work in many areas, and then their investments would sometimes be opposed to that. And I thought there has to be a better way. So started researching and bringing my two passions together, helping people reach their investment goals and make the world a better place. And I'm thrilled to say that now it's easier than ever. There are more and more choices. Who cares wins? The ESG concept was actually popularized in 2004 when former United Nations Secretary Kofi Annan invited financial institutions in Europe to develop guidelines and recommendations on how to better integrate environmental, social, and corporate governance issues into asset management. So these participants were Goldman Sachs, Credit Suisse, Morgan Stanley, Deutsche Bank, funding by the Swiss government. It was really a who of the global elite in banking. And these people were there not to be do-gooders or to make the world a better place. They were there to get a handle on risk. What they concluded, and this Who Cares When was the founding document. That was the title of the founding document, Who Cares Wins. So I want to strongly make the point that ESG investing does not propose doing good for goodness sake. Instead, it advocates doing good to become rich, because you will actually do better. There's a consensus around the United Nations Sustainable Impact Goals and new ways to align your investments. This is really just quite useful as a framework. The UN launched the Principles for Responsible Investment in 2006. And the preamble to these principles said, we recognize that applying these principles may better align investors with broader objectives of society. Never before had these broader objectives of society been more clearly defined than what are now called these SDGs, the Sustainable Development Goals. So you can see that there are 17 of them. I'm just trying to get over here. They were launched in 2015, and it's become a real framework. A lot of money managers use these. They might pick one or two and focus on them to make investment decisions. This slide is showing the large growth opportunities with the slides. And this comes from Allianz. They're saying that these sustainable development goals are a $2 trillion opportunity. And they break it down to food and agriculture, energy and materials, cities and health and well-being. So ESG matters. It's really about unlocking value. Investing is about uncovering risk and opportunity. And ESG really is just another piece of that puzzle. I think you'll find that literally all big money managers are now madly scrambling to get their ESG departments. I talk to these managers all the time, and you know, in the beginning, we were skeptical of people like BlackRock, who, you know, Larry Fink famously came out with his message that BlackRock was going to consider ESG, and a lot of old timers in the sustainable space rolled their eyes thinking, yeah, BlackRock owns more oil than Russia, for God's sakes. They're the largest investors in Aramco. But it's bigger than that. And it's not going to happen quickly. It's an evolving space. ESG is well done by a few firms, but it's a starting point. There are no very clear rules around this. But nevertheless, intangibles are increasingly driving long-term value of a stock. Intangibles account for 80% of a company's value. As active investors, I believe we really have to have a holistic view, which includes these intangibles and ultimately a company's ESG practices. So there are opportunities, and I'll show you how we can sidestep a lot of risk by being aware of a company's ESG score and how it works. So sustainable portfolios seek to provide more than just a financial return. Sustainable investing incorporates non-financial inputs. So, as I said, it's a way to manage risk, improve risk-adjusted returns, uncover opportunities, and achieve more than just return. Engage with investee companies to improve their behavior in environmental, social, and governance things. So a decade ago, we called this kind of investing socially responsible. And the term had an air of do-gooder, an investor who wanted to make money but also change the world. Now, don't get me wrong, I believe that identifying and living our values is now more important than ever. And I think we can all agree we want a safe, healthy, and prosperous world where people are treated fairly. More importantly, we want brands that contribute to the social welfare to prosper. A recent survey reported that the majority of consumers believe that brands are actually more powerful than governments when it comes to addressing social issues. You know, money has power. I recently talked to friends and colleagues about what they can do. Many of my contemporaries want to redouble their efforts to contribute towards justice or what's happening in our world these days. One simple contribution we can all make is to realize that our purchases have power. Where we spend and invest our money can be a vote for the values we want to support. It's amazing how money flows change corporate behavior. Today, as the world increasingly experiences the effects of climate change, extreme income inequality, oligarchy, crony capitalism, erosion of privacy, and so on, investors are understanding that these risks pose real risks. These issues pose real risks, not just to the planet, but to companies. So, again, identifying and living our values is more important than ever. This slide is showing that ESG, let's see. ESG management actively contributes to the firm performance. So last year was the second hottest year on record since modern temperature data collection began in 1880. Last decade was the hottest recorded. Ocean temperatures in 2019 were hotter than ever. Meanwhile, fire and drought were causing environmental disasters both here in Northern California and Australia and all over the world. But companies are feeling the heat too. I mentioned Larry Fink, a CEO of BlackRock. You know, they're the world's largest money manager. And he said BlackRock would begin divesting from investments that present a high sustainability-related risk. In many ways, this represents the shift in how investors are viewing sustainable investing too. The world is shifting and thinking about the purpose of the corporation. This is a significant turn from the long-standing view that the primary purpose of the corporation was to maximize shareholder value. The Business Roundtable said that the purpose of a corporation is to serve and create value for all stakeholders. I think millennials, women in particular, more and more people are wanting to hold corporate America accountable because we see what a huge influence they have. I have a friend that says, you know, corporations are certainly part of the problem and they've got to be part of the solution. So if you're investing in public securities, as most of us are in our retirement plans and even taxable accounts, we can make a difference. So what's driving this growth in sustainable investing? Well, demographic shifts, certainly. Younger generations have different preferences, more sensitivity. Environmental and social issues that have become increasingly critical. Transparency. At least 72% of the U.S. population has expressed at least a moderate interest. But more importantly, there's the opportunity too, that I think environmental and social change present a real opportunity for growth. It's proven that businesses involving their offerings to meet key sustainable challenges have performed better. One thing that people are really getting a handle on now is ESG materiality, how these intangibles increasingly drive long-term stock value. Poor ESG practices result in too much risk. So sustainable investing in the U.S. has been expanding at a really healthy pace. This chart is showing you total U.S. domiciled assets under management using SRI strategies grew from $8.7 trillion at the start of 2016 to $12 trillion at the start of 2018, the last year that USSIF had a survey. That was a 38% increase. So I can only imagine since then it's grown much faster. There's anecdotal evidence. We just don't have a survey. So this represents a 26%. $1 in $4 of the total U.S. assets under professional management are now considering ESG factors. And Europe, by the way, is far ahead of the U.S. in this. It really started in Europe, and Europe has, the reporting is much more robust there. The EU has embarked on a major project now to use financial markets to address sustainability challenges and foster transparency and long-termism. So it's growing. If nothing else, demand for these things is going to be healthy. And Lynn mentioned alternative investment vehicles. There was a 2018 trends report that identified $588 billion in ESG assets under management across 780 alternative investment vehicles at the start of 2018. This is nearly triple the assets identified in 2016, a 90% increase across a number of private equity and venture capital. So this is actually outside of the public security purview. Venture capital and private equity are looking at. Of course, community development funds, universities, institutions, universities in particular are being forced by their populations to look at it. I'm on a number of charitable boards, and finally, philanthropic organizations are putting their money where their efforts have been all these years. So environmental criteria are being looked at, values are being looked at. This chart is showing just the size of the industry. 46 trillion in U.S. professionally managed assets at the end of 2017, and how it's broken down by ESG incorporation and advocacy. So there's a big myth about SRI, or there used to be a big myth, that it doesn't perform as well. This myth has been repeatedly debunked. Sustainable portfolios perform just as well as conventional ones. So investors do not have to pay more to align their investments with their value. In fact, quite the opposite is happening now with the most recent research. But in 2015, Deutsche Bank, Deutsche Asset and Wealth Management, and Hamburg University published an article titled ESG and Financial Performance, aggregated evidence from more than 2,000 empirical studies. And they conducted this meta-analysis of 2,000 empirical studies from the 70s, making it the most comprehensive review of academic research. And they found that the majority of studies show positive findings between ESG and corporate financial return. There have been other studies. Oxford University and Arabesque Partners categorized more than 200 sources. There have been a lot of academic studies. There's another report by Morgan Stanley in 2015. If anyone wants to be pointed toward these reports, I think they're on our website, but you can always call the office. But in terms of real world evidence, which is more current, this is a chart from Morningstar, and it shows that allocating to strong sustainable funds actually had slightly better performance than global equities for this period from September 2007 right up to date through May 20. Sustainable funds performed better than traditional funds, and particularly on the downside. This is a responsible index return, again, just comparing broad groups of funds to broad market indexes. You can see that there's some, in global sustainable funds versus traditional. Year to date, you can see in every category, the sustainable funds were better on the downside. For the 1 year period, mostly the sustainable funds were better than their traditional counterparts. In fact, in every case for the 1 year period, they're better. For the 5 year period, they're all better. Actually, now that I'm looking at it, for every single period, you're seeing a performance advantage. And this, of course, is independent research. This came from MSCI. performance has been particularly better on the downside of sustainable funds. This is a chart that came from Allianz, and they're saying, given the extended 10-plus bull market, investors were very wary of how sustainable funds would weather the market turmoil, but it's shown here that both globally and in the US, companies with higher ESG ratings fell less in the COVID-19 sell-off. So lots of proof that sustainable strategies do not mean that you're going to sacrifice any return at all. In fact, I believe that companies that treat their workers fairly, that have great governance policies in place, and are saving money on good environmental practices are likely to be much more successful over time. So, you know, here's why. Happy workers are more productive. The company that exploits either resources or people may face fines or lawsuits that could really hurt its bottom line. I think we're seeing, and we will continue to see, that better labor practices and workplace safety are going to be rewarded with fewer recalls, fewer boycotts. The middle section says, renewable energy, of course, is going to help our environment by lowering emissions, cleaner air, less reliance on fossil fuel, but it also lowers operating costs. Gender and racial equality on corporate boards has actually been shown to have a high correlation with better corporate returns. So, you know, higher revenue, products that have successful products solve pressing human needs, and good products that are healthy and people want are going to be successful. Population growth is fastest in the lower income economies. New customers from these economies are seeking out lower priced products, or higher value, solar energy, more efficient. Procter & Gamble, for instance, is making single-use shampoos, a small package, because they're affordable. And everyday families in remote places like India can get these. In this market, 70% of all shampoo used in India is from single-use sachets, a multi-billion-dollar industry. Overall hygiene of these customers improves too. So, you know, if you get a company really looking at the welfare of the people, it's going to be well received and their products are going to do well. Another example is lowering costs. Lots of examples. One company, Interface, saved a cumulative $400 million in costs since embarking on energy efficiency, material reduction, waste reuse, and recycling. I somehow have missed a slide here and I can't see mine, but strategies for implementation. I think I'm going to come back to this. The one that I'm going to talk about first is ESG. It's really integrating these factors. I'll explain that first, and then if we have time, we can go into more stewardship and investment. So ESG risks have a material financial impact on companies. All investors can agree on that. Climate change can disrupt global agricultural supply chains, have an impact on the bottom line of firms ranging from Bayer to Starbucks. The Facebook Cambridge Analytics data breach represented a violation of the social network's social contract with its users. Its share price suffered as a result of that. Its failure to protect users' information. Failures of governance are the least controversial of all the ESG risks. When Wells Fargo branch employees opened millions of fake accounts to meet lofty cross-selling goals, there was no doubt that the poor governance was to blame. That fiasco cost the firm billions and left a lasting blemish on its brand. ESG scores in every one of these cases would have kept you away from that. So ESG really presents a framework for better understanding these risks. Historically, these risks were rarely discussed in companies' financial reports and quarterly calls, but since this started in Europe and most all companies report in Europe, a great percentage of companies in the S&P 500 are now reporting. This quote from Nuveen says, successful forecasting long-term market sector and entity-specific trends increasingly requires a comprehensive understanding of relevant ESG factors and their potential effects. So what is ESG? Environmental is perhaps the easiest to understand. Recycling waste, climate change, energy efficiency. Social, labor relations, human relations, executive compensation. Governance is increasingly important. Equality on boards, diversity, independent boards of directors. Executive compensation is a huge one. I have a neighbor that focuses on CEO pay because in the last 40 years, the average worker pay is barely moved, whereas CEO pay in some cases is very egregious. Some of our public companies pay their CEOs 2,000 times what the average worker pay is. The average over time should be between 50 and 100. Right now, our average is over 300%. So here's a little more detail. Governance is possibly the most non-controversial. Encouraging companies to make boards of directors independent, to improve their accounting standards, upgrade their audits. These are clear investor benefits. I think that I'll show you later how shareholder proposals are focusing more and more on governance issues. Here, wages provided to employees, foundations, donations to PACs and political candidates has been a big one. Allowing stockholders to vote on issues, the number of women and minorities on boards. These are all things we want to encourage. Environmental, as I said, is perhaps the easiest to understand. Outside the US, the global business community tends to agree that climate change is a huge threat that requires corporate attention, and they're doing a much better job than really holding their corporations to account. But, you know, in this time when our government seems to be backing away from some of the guidance in that area, we can hold corporations accountable. We can keep asking the companies to assess their impact on the environment. We see evidence all the time that government is moving in a positive way to protect our environment. So I think it's up to us to know what we're invested in and try and align our money with companies that are doing a good job. The social section, though, may contain some items that will distress those with a libertarian bent, such such as prodding firms to increase their workforce diversity or encouraging them to improve their connections with local communities. But I still maintain that in the end, companies are going to be far more successful with happy workforces. Allegedly, these suggestions are the best business practices, not personal preferences. Companies that follow ESG axioms are said to be sustainable. They preserve the environment in which they operate, maintain healthy rather than predatory relationships with other customers and employees, and avoid the pitfalls of corruption. So here's what ESG integration is and what it's not. It really is arming portfolio managers with tools and information to identify the risks and opportunities, enhancing the investment process. It's an added tool, making investment decisions that take financially material ESG information to it. It really is not a values-based exercise. For all the portfolio managers that I talk to, it's about risk management. And it's not about addressing shareholder concerns. That can be done with engagement and advocacy. Citigroup has recently created a division within its investment banking unit after the coronavirus pandemic increased the importance of sustainability plans for corporations around the world. You know, and they're joining rivals Barclays and trying to capitalize on companies' growing desire to lower carbon emissions and become more sustainable. I think we're going to continue to see that this is a critical area. And ESG ratings give you an easy way to see if a strong performing fund is also invested in companies that are trying to do the right thing. So this is showing you the growth of ESG incorporation just by money managers. So professional money managers, back in 2005, these are billions of dollars, for instance. So now over $11 billion is being managed by incorporating ESG research. We certainly do it in our firm with all the funds that we invest in. It's not necessarily easy for you to find the right ESG score, but Morningstar is one way you can look at their globe ratings. In 2016, Morningstar released the Morningstar Sustainability Rating to help investors use environmental, social, and governance, or these ESG information to evaluate portfolios. So now you can look at your funds on Morningstar and get a globe rating. The rating provides a reliable, objective way to evaluate how their portfolios. I'm reading Morningstar's description now. Frankly, we find differences. Morningstar gets their data from Sustainalytics, and it's been vastly improved in the last couple years. They are now considering materiality. They've replaced their ESG rating with an ESG risk rating so that they're actually looking at which risks are more applicable in which industries to increase the overall applicability for the usefulness of these ratings. So this is a screenshot of what their ESG ratings look like. They have the globes. At the bottom, they have a carbon risk score. And they actually give you a sustainability score. The lower, the better. So this one falls at 22. Severe high risk would be 50, and low risk would be 0. This is actually a pretty good fund. In fact, this is one of my favorite funds. And I take it with a grain of salt because I know the managers and what a great job they're doing, and Morningstar gives it only 4 globes. Their historical sustainability score is 12, which is good out of 1,400 funds. How they cut the globes, they say it's based on historical sustainability scores relative to the Morningstar global category. So at least 30 funds in a global category need a historical sustainability score. And the top 10% gets a score of 5, which is high, and 5 globes. The next 22% above average, the next 35 average. In our own portfolio management of sustainable portfolios, we also look at MSCI ratings. MSCI is really who started the whole ESG rating system, again, to manage risk. And they have a very, very comprehensive system. It's expensive, so the average investor is probably not going to pay to get those ratings. But they have recently started offering to the public a free service. So you can go on MSCI.com. This MSCI ESG rating aims to measure a company's resilience to these long-term financially relevant ESG risks. They leverage artificial intelligence and alternative data they collect a lot of alternative data to deliver dynamic investment relevant insights. There's another firm in New York that does the same thing. It's quite fascinating how AI can now give us scores as to corporate behavior, how well the corporations are performing in all these areas. So MSCI says their rating is designed to assess the resilience of a fund's aggregate holdings to long-term ESG risks. Highly rated funds consist of issuers with leading or improving management of key ESG risks. That's significant because many studies have shown that the actual score is not as important as the improvement in the score. The fund ESG quality score is assessed using the underlying holdings' overall ESG scores, overall ESG ratings, and overall ESG ratings trend, and is calculated in 3 steps. The fund ESG quality score is then mapped to the AAA to CCC letter rating. So that's identify, screening, rank, and reporting on the fund using that AAA to CCC signal. And then they look at ESG momentum. They gain insight into a fund's ESG track record, designed to indicate if the fund's exposure to holdings with a positive rating is improving or worsening. And as I said, studies have shown that that's a much stronger indicator towards good performance. They also calculate something called ESG tail risk, understanding the fund exposure to holdings with the worst of class. And avoiding the worst is maybe one of the most useful things we can do here. This chart is going to show you some of the high-profile examples of ESG risk and how by simply being alert to these companies' ESG score, you would have avoided some of these disasters. And Wells Fargo aggressive sales practices, there are $185 million in fines, $142 million in arbitration settlement, 2 CEOs were replaced, and the stock price went down 12%. You can see here Volkswagen, after their judgment, the share price was down 37%. J&J talcum powder had a legal liability. The stock price sold off 15. You can read for yourself. Boeing, another case where there was a potential legal liability and the stock price was down 26%. PG&E is our local utility, and their liability for the Camp Fire caused a bankruptcy and the share price down 87%. How'd you looked at these companies' ESG scores like the managers of these funds do, you would have avoided them. So now I'm going to turn to engagement and just tell you for a few minutes about my dear friend Andy Bihar, who runs an organization called As You Sow over in the East Bay. He's the one that said, corporations are responsible for most of the pressing social and environmental problems we face today, and we believe corporations must be a willing part of the solution. We can make that happen. As shareholder advocates, we directly engage corporate CEOs, senior management, to try and help them from the inside out. So shareholders are a powerful force for creating change. How can your investments offer a company improved behavior? Well, we can bring important issues to the attention of fund management. Win media attention to help educate the public, change how a company operates just by voting, and help companies move forward with progressive shareholder resolutions. So Americans are voting their dollars now more than ever, and we're seeing actual change as a result. Consider taking that step today. I'm just gonna show you some of the examples. As You Sow just has a remarkable history of engaging positively in companies. They began engaging with bottled beverage companies 15 years ago to encourage them to improve their bottle recycling rates. After dialogue and the filing of proposals for several years, Coca-Cola agreed to recycle 50% of its PET, glass bottles, and aluminum cans by 2015. And then PepsiCo agreed to an industry recycling goal. 50% of their plastics and glass bottles by 2018. Nestle Waters agreed to an industry recycling goal of 50%. So if these companies meet their 2018 goals, it'll mean that about 20 million bottles and cans avoid the landfill. And instead, they're providing valuable materials to bottling companies for recycling. You know, that's a tremendous change. Other things that this organization has done, they've convinced many of the fast food companies to stop using plastic straws. They got Starbucks to agree to stop using styrofoam. So these are really significant improvements. In the old days, people thought of corporate engagement as adversarial, and I'd like to make the point that it doesn't have to be adversarial at all. there are plenty of examples, and I'll move along quickly and show you a few where people really care about the products, they care about the environment, and working together, the company can actually make more money. Okay. So here, these are the top specific ESG criteria that money managers are looking at these days. Climate, carbon, tobacco, conflict risk is a big one, human rights, and transparency. So ESG has become a priority at both the corporate and investor level. There's growing demand from clients and marketplace for companies to show conviction on ESG related issues. So this is how money managers are prioritizing. And this is showing you the top specific ESG criteria for institutional investors. It's a little bit different. Conflict risk is the biggest. Terrorist or repressive regimes. I'm on one philanthropic board that specifically tries to divest from companies that are fueling weapons of mass destruction into conflict zones. Tobacco has been a common one for a long time. Of course, climate change and carbon. Board issues has come up to be more and more important, and I'm glad to see executive pay there. Executive pay, you know, when you think about it, comes right out of shareholder pockets. So this is showing that the percentage increase in assets affected since 2016 by that is 41%. Again, I'm showing you leading issues that are of importance. This is the number of shareholder proposals filed in the last 3 years. Proxy access is the most important. Corporate political activity. Environment, climate change, labor and equal. So let me give you a couple of tangible examples. Target. Amy Domini was one of the founders in this space, and their fund managers engage with targets to try and reduce the toxic PVC plastic in children's products. The outcome, they did it. Now Target has a sustainable product line, and other major retailers like Walmart and Sears followed suit. So that's a tremendous success. Another example is Trillium. They've worked with Whole Foods, Costco, and Target to report on food waste reduction. Had tremendous success. Another example is Calvert Funds, one of the giants in our field that only does impact and sustainable investing. I greatly admire that CEO and their team of people. And they prioritized engagement with electric utilities. The outcome there was 53 major corporations committed to source 100% of their power from renewable energy in the next 2 decades. They also recently got MasterCard to commit to a plan to cut greenhouse gas emissions 20% over 8 years. So, you know, tangible successes that are really going to help. Home Depot, another one. Trillium engaged with Home Depot, one of the world's largest retailers of old growth lumber at the time. And the outcome was a smarter use of natural resources. So now this really benefited Home Depot because now they sell more Forest Certification Council, FSC certified wood than any other company in North America. There are also small investor rights groups. And they are demonstrating positive impact. There's a group of nuns. They were concerned with not only addressing climate change, but the opioid epidemic. They got together a mammoth coalition of investors, born with the idea that, they were yielding influence of $2.2 trillion. And they urged the largest U.S. drug companies to take accountability for playing a role in the opioid crisis. The group, Investors for Opioid Accountability, has cut deals with companies in the business of making or distributing opioid painkillers to review how they oversee the sales of these addictive drugs and make other corporate governance changes aimed at improving supervision of the sales. No one in this country is untouched by the opioid crisis, and this is an example of how shareholders were really able to make a difference. I love this quote by Supreme Court Justice Louis Brandeis. Back to 1913, there's no such thing as business and obligation to see that those represent him carry out a policy that is consistent with the public welfare. So I pray that with everything going on in our country, we are going to, I think corporations are taking more responsibility. I'm working to see that shareholders do as well. I think with increased awareness, we're certainly going to see it. This is ESG risk moving to the top of the agenda. So this chart shows how many years for the last 10 years, going back to 2010. You can see economic are blue on this chart. Back in 2010, the World Economic Forum thought most of our risks were economic. But look over to where we are now in 2020. And this survey of the World Economic Forum actually thinks most of our risks now, our top risk is environmental. 3 of the top 5 are environmental, geopolitical, and social. I think that that's telling. Oh, I put this in about green bonds. I've been talking mostly about stocks, but there's a whole industry that is using fixed income as a way to also build support of clean energy, the environment, social things. And you can see here the tremendous growth in green bonds. So how do you get started with sustainable investing? There's certainly been an explosion in demand for sustainable funds, so that's led to a much broader universe of dedicated SRI, ESG, and impact funds. Every major money manager has a handful of, I think BlackRock now has 8 iShare ESG funds. There's lots of new research. You can go to either Morningstar or MSCI for free, I believe, and get an indication of the ESG scores of the funds that you like. All this new research allows us to evaluate nearly all funds based on sustainability and ESG factors. In the early days of managing funds, we used to limit ourselves to the self-proclaimed sustainable funds because we knew the managers were voting how we'd want them to vote and doing well. But since these ESG scores are available to us, we've really opened up our universe, and the opportunities are almost unlimited. Interestingly, we found in our scoring system, when we manage money, performance is still always going to be number one with us. I'm not going to invest in a fund unless the performance is there. Then it also has to have a high ESG score. Sometimes I'm finding that value funds that have always focused on good management have high ESG scores because they've focused on governance. They've focused on perhaps treating their workers well and having good policy in place. So our fund, we have a mutual fund that follows our same strategy, and we also have separate accounts that invest only sustainably. We invest in the funds with the best performance that also have a high ESG score, whether or not they're self-proclaimed. So we apply that very same upgrading strategy of sorting the funds by risk, investing with the top performers, but then we also have this additional screen. I would say if you're doing it yourself, you follow the same strategy. Make sure you're aware of performance, number one. With our particular strategy, we do focus on engagement. We do prioritize funds and ETFs that engage with voting. I mean, not too many years ago, I think it was only a year and a half ago, that Vanguard voted for the very first time in favor of any environmental positive movement by a corporation. It just wasn't done. You could say it's because probably Fidelity and Vanguard and State Street, all the big managers, are also managing the pension funds of these big corporations, and they don't want to vote. They don't want to vote in opposition to management. But that's changing with Larry Fink from BlackRock. As I said, Vanguard for the first ever time voted in favor of a very positive environmental. It was just a request for a company to disclose their environmental impact. It was nothing that was going to hurt the bottom line. In fact, it was going to help. But I think voting is very important. So we do prioritize the funds that we like their voting record. There's a focus on engagement. But as I said, we stick with our time-tested approach of first risk management, then focusing on performance. We want to always be with experienced performance, but we pair that with high sustainability ratings.
Janet, so do you think that the ESG filters will essentially, I guess, benefit larger companies over the smaller companies?
You know, that's a great question, Celia, because larger companies have more reporting resources. We were seeing initially that they were reporting more effectively. All the money managers that I talk to start with MSCI, for instance, because they're the oldest in the game, as a starting place, but then they do their own ESG research. So there are a lot of small companies, small cap managers that now are getting pretty good at going to management with their checklist. Also, reporting has become much more widespread. I think nearly all companies are now reporting something. But the managers that are focusing on small companies are actually going to those companies and finding. So I don't think they're, you know, I heard some criticism about Morningstar and Sustainalytics ESG ratings in the early days that small companies were disadvantaged. Now that they've changed their system and they're really applying materiality, what they're doing is trying to look industry by industry, size by size, and see what's material in this company's behavior regarding their environmental, social, and governance practices. For instance, environment, of course, is far more important with an oil company than it is a tech company. But, you know, supply chain may be more important with a tech company than other companies. So we're getting better. I think it's important to remember that this is new. You know, even though it started in 2004, most people had never heard of it a couple of years ago. It's developing. One of the biggest criticisms I hear is there's no real standard, and there isn't. It's developing. But I don't think that matters. In my book, I think because we're trying to address it, we're trying to get a handle around it, we're trying to avoid the worst offenders where we think there may be blow-ups because of really dangerous practices and avoid those risks. If we can just do that much, I think we can improve our investment results. But by aligning with companies that are at least trying to vote the right way, that are at least trying to keep their corporate governance in line, I think we're much more likely to align with progressive companies that are going to excel. I think if nothing less, the demand for these kinds of companies will be supportive going forward. So I think that, it's a fairly strong bet that with all the millennials inheriting wealth, women, it's increasing. It's the fastest growing area of the mutual fund and ETF world. So I do think it's something for us all to be aware of.
Absolutely, Janet. And thank you for kind of, giving us a view into the process that's being used to, tie our societal concerns with how to influence corporate behaviors. Now, just curious, has there been studies on whether ESG has effectively offered a leading versus a lagging indicator?
Well, by leading, so I did show you, let me go back. I did show you that the funds with high ESG scores have better returns, and I think that went back to 2007. And this chart shows the year, 1 year, and 5 year. So here you see slight outperformance of the highly ranked ESG funds to the non. So I would call that leading, wouldn't you? I mean, but what's powerful to me is seeing those examples of the funds that had low ESG scores, that had major disruptions and their share prices fell so much. Even if we could avoid disasters, that would be a benefit. But this chart to me indicates that certainly there's no lagging performance. I mean, it's one factor, and I just think when I talk to clients, I say, okay, we can invest in excellent funds for you, and on the other hand, we can invest in excellent funds for you that also are trying to treat their workers fairly, improve the world through environmental practices, and do a good job. Which would you prefer if performance is the same? I have yet to find anyone that doesn't want to align with companies that they feel positive about. And again, it doesn't just have to be a do-gooder thing. It's just, I think most of us probably feel good if we know that our company is with people that we respect and we trust that aren't doing terrible things to the environment. And if more and more people do that, think of the support these companies will get will eventually enable them to even do better in the world. So I feel that it's a strong argument to align with companies that, again, you respect.
And for the ESG factors and updates, do you find that they're usually updated on a quarterly basis or on an annually basis?
Let me just look, I think the best many of your listeners can probably do is to go with self-identified funds. The top fund in our class 3 right now is Brown Advisor. Nothing to do with me. BAWAX. I've held that fund for at least 2 years, which is a really long hold for us. They are a self-identified ESG screened company that's always going to stay on top of it. Morningstar, I think, only updates quarterly, but I think MSCI does monthly for their free. We pay a lot of money to get different levels of service from them, so we get it monthly, but I'll have to check. Somebody can call the office. I think the free service may only be updated quarterly on Morningstar, and I think they're on a rotational system when they update. MSCI, I believe, is monthly. But you could also align yourself with an advisor that specializes in this. My firm is on it every day. We get constant updates. You can invest with fund managers who are actually doing this. We have a mutual fund that I love because it's our growth strategy, but it also invests only in funds that have high ESG scores. It did better on the downside than our FundX fund, and it's doing better on the upside. So, in my view, what's not to like? But certainly talk to your advisor. If you're working with a money manager, make sure that they're aware of this. Make sure that they are looking at these things, would be my advice.
All right. Feel free if anybody has questions to type that into the chat box, and Janet will let you kind of finish up your presentation.
And I think I'm there. I think I started a page through. I went back to that performance chart. I believe I had gotten to the end where I was just summarizing again. I believe success depends on flexibility because markets change, and we've got to be disciplined in responding to changes, whatever universe you invest in. It can be sustainable, it can be aggressive, it can be bombs. Doesn't matter. Markets are going to change. You got to be alert. Don't worry so much about the benchmarks. Be aware of what the market is doing. Be sure you're participating. Be disciplined. That's where having a plan comes into place. You can look at our newsletter. There are lots of strategies that work, but I recommend you choose one and stick to it. I put humility in there because we all make mistakes. We're not perfect. Markets are not perfect. We all do it. Just be careful to limit the damage. Build safeguards into your strategy for when things don't go your way. I think that's one of the best things our strategy in our newsletter does. When things turn around, we have a strong sell discipline. If it's not working, get out. So you got to have those safeguards to limit the damage. And then this is the same free weekly investment guidance that I would like to offer you. If anyone wants to sign up for that, you can go to our website and input your information, and then weekly we will give you our view on what's important, what's happening in the markets, those kinds of things. And I put in another slide saying, you know, sometimes people are better off having a trusted advisor. If you're not working with an advisor now and you'd like to find out what that looks like, please call me. We have 5 advisors, myself included, and you might consider how a coach can sometimes help you achieve better performance. Sometimes I like to look at our investment advice as not only managing the money, but coaching investors to get their allocation right, to write it through when that's in their best interest. And, you know, for over 50 years, we've been helping investors. So that's what we do at FundX. And I would just like to thank you all for listening. And I do encourage you to call if you have any questions at all. We're all local here in the Bay Area and have a number of people that really enjoy talking to subscribers or shareholders. So we'd be happy to answer questions if you'd like to call.
Well, thank you very much, Janet. This has been so informative.
You're
Now,
very
for
welcome.
anyone who's able to stay on, we don't want to keep people if you need to go. There is one other question from our audience, Janet, which is with respect to sin stocks, how would they be graded in terms of ESG?
Pretty lowly. I mean, there are some, as you know, there's a mutual fund that only invests in so-called sin stocks. A variety of funds have different criteria. There are some funds, our fund, for instance, does exclude tobacco and weapons of mass destruction. We do not exclude gaming. Some funds exclude gaming. There are even some funds that follow Sharia law, and they exclude financial institutions that charge interest. So you can tailor your particular goal with the manager. What you'd usually do is go to an advisor and talk about what you want to avoid. And the manager can help you build a portfolio. If you don't want any sin stocks, easy enough to exclude. They're excluded from most of the SRI funds. You know, these days with our technology, it's really easy to exclude things and to focus on other things. But I would imagine most sin stocks would probably have quite low ESG scores. I'm not positive about that. Call me in the office and I'll look it up for you. Give me some names. I have one client who is a lovely woman, raised Catholic, but she does not want to invest in, what is it? She's an impact investor, has been for decades, loves it. But some of the impact funds do not invest in birth control, and she's a strong believer in right to choose, so she doesn't want to invest in any of those funds that exclude birth control. So you can really get very specific. I think for most people, it's good enough knowing that we're in good companies that are trying to do the right thing in this world, trying not to be the worst offenders of pollution or things like that. But you can get very specific. Hope that answered the question.
I think so. All right. Thanks again, Janet.
You're very welcome.